The Magnificent Seven has underperformed the Russell 2000 index by quite a big margin this year. The stocks that are doing well across the globe are those that are supplying the equipment.
Europe is rather defensive-ish as sector distribution as opposed to US. What about Asia? What about China?
But the Chinese market, I think it is still cheap. I think there are lots of interesting things going on in China, lots of interesting technology investments available, but the market remains actually pretty cheap, whereas the US market is really expensive.
Interest rates are going to be kept steady by the Fed. What would that mean for gold?
But in my opinion, gold went through a bubble. The onset of the war with Iran, that gold was the worst performing asset.
Hello everyone and welcome to our podcast series where we are going to talk about the current market environment and what can we expect in the next half year. I have today the big pleasure to welcome back on our podcast Paul Jackson, Global Strategist for Invesco. Paul, welcome.
Thank you. It's great to be back.
Happy to have you again with us, and I'm sure our listeners would be thrilled to hear your insights. Paul, I think without further ado, we can hop into the topic which is on everybody's mind, the current market environment. It's a very challenging market environment. We observe tremendous jumps of single instruments, particularly single stocks in the tech field. We've seen a roller coaster ride of silver in the first half of the year. We've seen a historical drop in the cryptocurrencies. We see equity markets, particularly driven by AI and general tech in the US, literally chasing one record high after the other. We would love to hear your view on that.
Yeah, well, we started the year in optimistic mood because we thought the global economy would accelerate, there would be more economic growth, and the market started the year very well. Small caps were outperforming, non-US markets were outperforming. Then we had the war with Iran, which came at the end of February, which pushed up energy prices, which is always frightening because that brings more inflation and perhaps higher interest rates. But to be honest, the markets weathered that very well. And when you look at the first half of the year, it is cyclical assets such as equities, real estate, even high yield that have performed the best. And of course, alongside energy, because oil prices went up a lot. But cyclical assets have performed very well, which is quite surprising given the rise in energy prices. Now that energy prices have come back down, we're actually pretty optimistic again. So we think that it will be a good environment for those riskier, more cyclical assets, but I think there will also be a broadening out away from the big technology stocks to other parts of the market, which I think is good news.
You're right, and it's a healthy way to diversify as well, because as we know, in a downturn mood, those are going to be the asset classes which probably would be among the most punished or suffering ones. With respect to the second half of the year, given that there is a lot of uncertainty what's going to happen with the US interest rates, we know that Kevin Welsh is rather hawkish, at least that's his history, whether he'll keep the policy to be seen. But there is a good reason to believe that US may consider, or the Fed may consider, if not holding the rates at least one hike or two. Inflation is a topic there. What do you think, what can we expect across asset classes in near future?
Well, first of all, when it comes to the Fed, yes, we've had a change of chairmanship, which can be important. We've already seen some changes in the way that they communicate. Very short communication after the most recent meeting. The Fed indicated within their own forecast that what we call the dot plot, the members of the Federal Open Market Committee, the ones who make the decisions about interest rates, they think that rates will be higher later this year. But you have to bear in mind, with energy prices falling very rapidly, now there's a expectation that the Strait of Hormuz will open, I think oil and gas prices will come back closer to where they were before the war. That will bring down inflation. So headline inflation will come down pretty rapidly and will fall below core inflation. Core inflation excludes food and energy. The problem for the US is that core inflation has actually been trending up, and I think that's what the Fed will be a little bit worried about, and some members of the Fed are talking about that. However, our view is that with the new chairman, with headline inflation coming down, the Fed will not raise rates. But we don't think they will cut either. So for the rest of this year and into the first half of next year, we think the Fed will keep interest rates where they are.
That's very interesting. And what would you say, is that a good signal for which asset classes in that case, if indeed the Fed keeps interest rates steady?
I think if the Fed keeps rates steady, first of all, it's not particularly negative or positive for example, cyclical assets or long duration assets. So I think that the trends that we have been seeing with equities doing well, I think that can probably continue, but the asset categories that benefit from that stability in interest rates are particularly the short duration, very defensive assets, things like cash, AAA rated CLOs, which are basically just like cash but with a bit more of an interest rate, and even bank loans where there is some default risk, but at the moment default rates are very low. And there's virtually no duration, which means that when interest rates move, you don't get a big move in the price of those sorts of assets. But if the interest rates stay high and if the Fed doesn't cut rates, assets such as AAA-rated CLOs and bank loans, you continue to get a good interest rate over time. And we view them actually as a very good diversifier. So we like cyclical assets, but we've also got some defensiveness through those assets.
That makes absolutely sense because, again, it's good to have, well, not exactly cash-likes, but short-term fixed income-alike instruments in the portfolio to buffer and to weather stormy times. It seems to be still the time of the cyclical assets, particularly cyclical equities. We seem to be in the middle of the super cycle of semiconductor producers that seem not to end. I'd be very curious to hear your opinion on equities particular, and then we can go maybe asset class by asset class. Mm-hmm. We covered short-term fixed income, long-term fixed income. You mentioned also that at the moment, with respect to the longer part of the curve, we can be relaxed if there is no change on the interest rate environment.
I would say relatively relaxed. I think that there is still a bit of room for example, 10-year US Treasury yields. Even if the Fed doesn't change rates, that 10-year yield, I think, can still move a little bit higher. For example, from around 4.5%, I would guess to something like 4.75. So that just dampens the return on those longer duration bonds.
That is true. And interestingly, the long-term rates, also for our listeners, are the ones the Fed cannot control directly. This is question of supply and demand on the market and respectively demand for long-term fixed income securities. And as you say, we are observing currently a rather higher levels or relatively high levels, 4.5, again towards 4.5, and potentially, as you mentioned, we might see even 4.75% return on the 10 years Treasury. Interesting.
If I could just jump in.
Yes, please.
The situation is actually even worse than that as far as the Fed is concerned. Not only can they not really control the longer end of the curve under normal circumstances, but Kevin Warsh, the new chair of the Fed, has suggested that the Fed balance sheet is still too big. So he wants to reduce the holdings of assets on the Fed balance sheet, which means actually releasing US Treasuries back into the marketplace, which is increasing supply, which could actually push up the yield on those treasury bonds, and obviously you will get an effect at the long end of the curve coming from that.
Yes, and I'm actually very curious to what extent he's going to really do that. We know from the environment there that depending on the state of the economy, particularly in the equity markets, which seem to be these days really running the show in the US economy, also there, federal governors seem to be rather flexible on what is claimed to be a solid policy and then how do they adjust on the short-term movements. But yes, indeed, Kevin Welsh seemed to be someone, or is known as someone who is rather on the discipline side when it comes to money creation, and this could be very well the case that he really follows through with his announcement. To be seen. To equities, we've seen an amazing race again, and US equity markets recovered very quickly after the deep dive they had end of March around the conflict with Iran. Since then, we've seen single equities tripling, the broad tech indices, NASDAQ and also S&P 500 rising substantially. Do you think this trend will sustain throughout the second half of 2026? And that would be the first question. And the second interesting question would be, what can we observe in Europe?
Well, I think when you look at the performance of, for example, the large caps, the mega caps in the US, it's been very varied performance. If you look, for example, at the Magnificent Seven, the Magnificent Seven has underperformed the Russell 2000 index, which is an index of small and mid caps, and it's underperformed by quite a big margin this year. So some of those mega cap stocks, which had been doing well in previous years, have stopped performing. And, we talk about artificial intelligence hyperscalers, those companies that are building out data centers, for example. Those companies actually are not doing that well. The stocks that are doing well across the globe are those that are supplying the equipment. You already mentioned semiconductors, but also computer manufacturers. And that is why the markets that have done really well this year, it's not the American market, it is markets such as South Korea and Taiwan. The Taiwanese market has doubled in the last 12 months. The South Korean market has tripled in the last 12 months. And the Japanese market has done very well, partly off the back of this phenomenon. So I think at the moment, given the large investments made by the hyperscalers, the market is perhaps expressing a bit of doubt about whether they will be able to monetize those investments, but they're saying, well, if they're willing to buy all the equipment, we might as well invest in the people supplying the equipment. So I think that is where the attention has shifted. And of course, in Europe, we don't have so many of those types of stocks. But in terms of the US market, we've already had a broadening. And the US market has performed pretty much in line with non-US markets this year. I think psychologically, we think there's been this focus on AI-related stocks in the US. But as I said, small mid-caps have done pretty well. And I think there will be a broadening in the second half of the year. And to explain that, maybe we just need to take a step back and think about why did the AI and tech stocks perform so well since the invasion or the war with Iran? And I think the answer is that if you start to worry about the global economy, oil prices go up, you worry about inflation, central banks tightening, and then economic recession, in that environment, you're looking for growth stocks, companies that can grow no matter what the economic environment. So the theme of artificial intelligence came right back to the front of mind. But now that that is all, those concerns are abating, and we've seen even just this morning PMI data released for Asia and Europe suggesting that economies are strengthening. If you're thinking you're going to get that economic acceleration, you don't need those growth stocks. So you broaden out the performance to, again, small and mid caps, to value stocks, to industrials, perhaps still to financials, to metals and mining stocks. So I think there are plenty of places in the market that can benefit from better economic activity. And as a result, our attention will be less focused on the tech stocks, which honestly, I think probably are expensive now. But there are plenty of other areas of the market, the global market, not just the US, plenty of other areas that I think are a good value. And you find much more of those sorts of investments in Europe than you do in the US, for example.
Thank you very much. This is very insightful. And the interesting part is also that Europe is rather defensive-ish as sector distribution, as opposed to US. We're more into broad financials, industry, consumer cyclical. At least our Swiss market is very much into healthcare, consumer staples, and barely have pure technology, except of ABB, obviously, but it's also a mixed one.
I would just say that European markets in general, I would consider them to be more cyclical than the US, because the US has the concentration on growth stocks.
Yes.
Europe has got much more cyclicality within it, in my opinion.
It's interesting, yes. We covered the equities, and I think from what I can take as an insight is a well-diversified portfolio, particularly now more than ever, would really do a good job across the broad US market, having in mind that the small and mid caps are actually on a quite good run compared to the mega caps. Broad European markets are also expected to profit from the released tension on the energy sector and coming into growth modus. And what about Asia? Is this trend going to continue, which we're seeing in Japan, in South Korea, Taiwan? What about China? What can we expect there?
Yeah, it's an interesting one, because if you look at which regions of the world are most vulnerable to an energy shock from the Middle East, Asia is number one on the list.
It's true.
Asia is very reliant on energy imports from the Middle East. Then Europe, and then the Americas, not really. So you would have expected that in terms of market performance, Asia would have been the most impacted, and then Europe, and then maybe the US. Europe didn't do very well through all of this, but Asian markets, depending on which one you're looking at, have done pretty well. But you mentioned China, and China is the big market, which funnily enough was probably less vulnerable than somewhere like Japan to the energy shock. But the Chinese market has actually not had a very good year. It did very well for the 2 previous years, was outperforming. I think it is still cheap. I think there are lots of interesting things going on in China, lots of interesting technology investments available. They are a long way ahead in terms of robotics. So I think there's lots of good things to look at in China, but the market remains actually pretty cheap, whereas the US market is really expensive. Other parts of Asia, you mentioned, again, we've spoken about Taiwan and South Korea. I was in Taiwan maybe a month ago, and when I did a presentation in Taipei, I did suggest to the audience that, first of all, you must be very happy because you've been making a lot of money from your domestic investments. But if I were you, I would be diversifying, because
currency,
all things must pass.
Yeah.
Nothing goes up in a straight line. And diversify in terms of asset choices, but also in terms of regional and national choices. So again, those markets of Taiwan and South Korea, they can't continue to generate those sorts of returns. But other parts of Asia, if we do get this global economic acceleration, there are other parts of Asia that I think can benefit from that. So, China is an obvious place. These are all trading nations, so they all benefit to some extent. But China, because it's been lagging, and then you look at smaller markets, places like Vietnam is very trade oriented, for example.
Small open economy, yes.
Yeah, and if we include India in Asia, which we do, the Indian market has been struggling for the last few years. Everybody loved India. If you go back 3 years, it was everybody's favorite emerging market, but it became so expensive as a result of that. Now it's become cheaper because it's been underperforming, but I don't think it has yet got to a point where I would say
It's interesting to enter.
it's good value. So yes, it's a strongly growing economy, but that usually doesn't mean a great deal in terms of stock market performance.
Thank you very much. That would have been my next question. And absolutely, I'm very much looking forward to see how China is going to develop. We saw South Korea dip right after the crisis because they're very dependent on oil from Middle East, but then they recovered incredibly quickly. So did Japan, fantastic performance, Taiwan, as you mentioned, and China is indeed lacking, even though they seem not to be so dependent on oil. So interesting takeout also here. All eyes on China to see how they're going to develop, still value there, and cautious on South Korea, Japan, Taiwan, as they're actually having quite a momentum since quite a while, more than a year, I would say, the last 2 years. Let us then move maybe away from equities for a moment and come back to something which is also on a lot of people's mind, but seem to have dropped of attention. It's not anymore so hype. Precious metals, gold and silver.
Yeah.
When we can start with gold, can we heard a lot in the press that given rising interest rates, and it's enough to have only expectations for rising interest rates in the US, that would automatically divert some of the demand from gold away and put it into treasuries. But if we would expect a scenario, as you say, that interest rates are going to be kept steady by the Fed, what would that mean for gold?
Well, first of all, gold did fantastically well over a number of years, and the price rose to a level that, frankly, you couldn't explain by any model based on interest rates or dollar or whatever. So in my opinion, and some of my colleagues have got very different opinions, but in my opinion, gold went through a bubble. And it was interesting that with the onset of the war with Iran, that gold was the worst performing asset since then.
Yes.
When you would think in a situation of conflict, a geopolitical maelstrom, that gold would perform well. But I think it had just become so expensive, we had this exponential price path, that we usually talk about a lot of good news being in the price. In the case of gold, I think a lot of bad news was in the price, because people worried about geopolitics were pushing the price up. And then, yes, bond yields went up a bit, the dollar strengthened a bit, but not enough to justify what has happened to the price. And if you look at who's buying gold, in 2025, central banks bought 20% less gold than they did the year before. The demand for gold for jewelry purposes was down 20%. The demand for industrial purposes, including semiconductors, was down a little bit. The only component of demand that was up was investment. And there was a big turnaround in ETF flows into gold. There'd been big outflows from gold ETFs over a number of years, and then that turned around. And the great thing about investment is it is the one component of demand that doesn't always fall when prices rise. In any market, you could be buying potatoes. If the price goes up, you'll buy less potatoes, maybe buy more pasta.
Elasticity of the demand and supply, yes.
But investing, very often when price goes up, we actually buy more because we get encouraged to jump on the bandwagon. We want a share of those profits. It's the fear of missing out. All of those kind of behavioral, we get a dopamine buzz when we make short-term profits. All of those behavioral aspects kick in when it concerns investment. And so an upward rising trend actually encourages more demand. Nobody likes to buy a falling asset, but they love to buy a rising asset. And they can only see the good things. And I think that's what happened with gold. And you mentioned cryptocurrencies at the very beginning. We'd had a similar thing with cryptocurrencies over recent years. And that bubble burst maybe a few months before the gold bubble, but they're both following a typical path of that financial manias follow, and so far the downward path fits that pattern quite nicely. So I think that gold was probably just overbought. For the long term, gold can play an important role, a diversifying role within portfolios, as do commodities in general, but maybe there'd just been too much excitement, and that probably explains why the price has been coming down.
Thank you very much. Super, super interesting. And it really explains very well the relationship between gold as an potential inflation or crisis hedge, and equity markets. And indeed, it was super interesting to observe that gold actually did not do its usual job around crisis. And it has to do with the fact that we've been in a bubble with respect to prices. And that's the thing about correlation, long term. Yes, gold could be considered as a good hedge against inflation and a good stabilizer in a portfolio. But short term, depending on where it is in the cycle, its own pricing cycle, it could be just too overvalued to fulfill its role. Yes. And that is what we observe now with the crisis. But it was super interesting also to the way you explained the details and the mechanics of the price building. One last question with respect to with respect to commodities, silver and rare earths.
Right. Well, silver for me is just it's kind of the satellite that flies around gold. So very often gold moves first and then arbitrage kicks in. So when the gold to silver ratio goes up too much, then people switch from gold to silver. And then because silver's a smaller market, it moves very quickly. So there's not as much liquidity as there is in the gold market. So you get very sharp price movements. And then for a while, that excitement about silver can actually then give you more excitement about gold. The two feed off each other. But then very often, when it comes to the downside, silver just falls a lot more than gold because of that lack of liquidity. If you think about it from a jewelry perspective, if you think about wedding rings, for example, my wedding ring is not gold because when we got married, gold was expensive. So it's not silver either. I think it's palladium. But we can all arbitrage. So when prices become too expensive, we switch to something else, and that's what tends to drive silver. If gold goes up a lot, silver then reacts eventually to that. And I think that's what drove silver to very high levels, but it's come down and collapsed a long way. So I think my outlook on silver is intimately linked to my outlook on gold. So yes, over the long term, a good diversifier, but perhaps in the short term, still on the expensive side.
That is interesting. Often you hear that silver, and it was really behaving like a meme commodity, in fact. And I think we saw some kind of a bubble, as we observe now, also in the 80s, if I recall the history of price building of silver, when it literally went in a very short period of time. I think it was the early 80s. And then it collapsed overnight again when I think it was the Fed who actually all of a sudden changed the rules around trading of silver, and people could not buy anymore. They had to, or it cannot. There was a change between purchasing and selling rules and regulation around that, and one of the sites was kind of kicked out.
But there was also the fact that in the late 1970s, gold shot through the roof, and so silver followed that.
Yes.
And in the late 1970s and maybe early 1980, you had these famous news items of showing you people queuing up outside gold shops, sort of queuing around the street trying to buy gold coins. And so that was the first time that I was aware of such activity. But then for the next 2 decades, the price of gold just kept going down.
Yes, yes. It's very interesting. It's almost like the tulip crisis in what we read from the historical books in Netherlands. But back to silver, there was interesting. There was a theory, or some of the commodity research would claim that we are in a strong deficit, chronic deficit with respect to silver when it comes to its usage in the industry. Would you have some thoughts about that? Is that really the case? Are we coming to a point where the reserves on silver are actually kind of used up, and the only adjustment goes through prices?
Well, gold and silver are, by their very nature, limited in supply. You can only increase supply to a certain extent. But of course, as price goes up, supply does go up because it becomes more profitable to exploit previously uneconomic mines. Also, you get much more recycling activity. So the increase in
course.
supply comes from recycling as well. But also, just as I was mentioning for gold, silver, it's the same, that when the price goes up, those who are using it in industrial applications will try to find alternatives. They'll try to economize on the amount of usage, and they'll try to find other metals that can do the same. So you had the same thing, gold, okay, can we use silver instead of gold because it's so expensive? Oh my goodness, silver has become really expensive. What else can we use? And at the end of the day, if the price becomes too high, we just stop buying the things that contain it. And you may say, well, we need all of these things, but it's amazing when things become so expensive, consumers can't afford to buy, so demand starts to come down as well. So for a whole host of reasons, rising price cycles can't continue forever. But we like to create the narratives and explain why they will go on forever. Rare earths, it's a similar sort of thing. I guess part of the clue is in the name, and they are very important in industrial applications. And so there's probably a lot more cyclicality in the demand for rare earths than there is for gold and silver. There is an element of cyclicality because of those industrial applications. But for things like gold and silver, there's jewelry demand, there's maybe there is investment demand. It's not all industrial applications. So when the global economy does better, there'll be more demand for rare earths. As the global economy softens, there would be less demand. But you also have the greening of the global economy, which adds to demand for the rare earths as well, and so that naturally will keep prices rising over time. But if you go back 5 or 6 years, I think, when you had this massive boom in rare earth metals prices, it didn't last. They came down very quickly. So all of these metals and raw materials, they go through cycles.
And it seemed to be quite big cycles with a lot of ups and swings. Thank you. This is super interesting, and it's good to know because we've seen a huge amount of interest into rare earths in the past couple of months, I would say around 1 year, 2 years. And I think it answers the questions, how the dynamics of these markets look like. Anything we've missed which you think you should share and our listeners should know in the current environment?
Well, first of all, don't chop and change. Don't be trading too much. Stick with your long-term strategy and your long-term philosophy. That suggests that if you can stick with long-term principles, then you're losing less money in terms of trading, but also you make less mistakes. And over the long term, we know that there is a risk premium on, for example, equities. So it's a more volatile asset category, but over time you do earn
capture it
more money than on other assets. And trying to time markets is very difficult. So don't get too clever. Stick with your longer term strategies. Put money into the markets a bit at a time, and keep it there. It's that long term return that really builds up your assets and builds up your investments. In the short term, what didn't we cover? Probably the view on the dollar. The dollar, interestingly, did strengthen after the Fed's first meeting. It strengthened on the back of the war with Iran a little bit, and then it strengthened a little bit more after that recent Fed meeting because of this idea that the Fed may raise rates. We think the dollar is still quite expensive. We suspect that over the next couple of years, the dollar will weaken a bit, which probably helps commodities and probably helps emerging market assets. In terms of regional views across assets, the regions that we still favor, if you look across all of the assets and add it all up, the regions that we still favor are emerging markets and Europe, and actually some UK assets. Things like UK gilts, we think are actually relatively good value at the moment. But Stick to the long-term view. And what helps you stick with the long-term view? It's happiness. Stay happy. Don't worry, be happy.
Oh, I love this one as a closing. This is amazing, and this is how our talks always finish. I was waiting for this one. Keep a cool head and be happy. Thank you so much, Paul, for being with us today. And as always, for those of us who are listening, should you have any questions to Paul, write us at hello@umushroom.com, and we are going to pass them further to Paul and get them answered. Thank you very much, and thank you once again.
Thank you.